Okay, so prices are going higher, hitting all-time highs yet again. We've got not enough supply coming into the market, and there's so much in between going on with banks cutting rates, but the RBA hasn't made any mention of interest rate cuts. If you're interested in knowing what my thoughts are on this wacky world of real estate here in Australia, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, if you're new here, my name is Ravi and I run one of Australia's fastest growing buyers agencies with more than 40 full-time staff. We help everyday people like yourself go and scale up their portfolio so you can live a life of choice and financial freedom by having a portfolio of real estate properties. If you're interested in knowing how we can help, creating a strategy, an acquisition plan, and just going out there and dominating to get the best deals for you, then definitely use the link in the description below to book a call with our team. It's completely free. So with that, let's continue. Now, the latest data has come out, and according to PropTrack, it is the 20th consecutive month that we have seen prices go higher. And at this point, some people are like in complete disbelief because we were promised that the market was going to crash. And on the other side, we've got people saying, no, the crash is coming. It's happening today, tomorrow, or probably next week. Overall, I'm an optimistic dude, but I'm definitely not afraid to mention that over the next 3 to 5 years, we're going to see so much money change hands. It's not even funny. There are going to be people that are going to get caught out because they over leverage themselves. Some people picked up the property in the wrong area. That's why you need experts around you. Because I feel like to a certain extent, over the last couple of years, we've been playing in easy mode. I've been doing this for about 11 or 12 years. And I can see some of the properties people purchase and some of the other BAs that are out there purchasing these properties. And I'm like, mate, these are the sort of things that get people into a lot of trouble. So instead of just sitting there with fear and being scared around what could happen and if the market's going to crash, why not just outsource that sort of stuff, get the experts to do what they do best and guide you into getting into the market at the right time. What we're going to see is huge amounts of growth over the next couple of years, but we will also see some sort of correction. And you want to be positioned for both, because if you can position yourself for not only the growth up, but also the decline down, I'm telling you now, it's life-changing money. Think about everyone that bought during the time we had the GFC and straight after that. This is where you can get time in the market and timing the market to a T, and you'll make a lot of money. So this is the PropTrack Home Index coming out, and housing demand seems buoyant, defying affordability constraints and fueling continued growth across much of the country. However, performance differs around the country, with the balance between supply and demand the primary factor driving the variance. It's exactly what we talk about on this channel. You can't just say, oh, I'm going to buy anywhere and hope the market goes up. Now, we've got monthly growth here, we've got annual growth here, and this is the median value. What we'll see is nationally prices went up by 0.2% in the month, but annually it's up 6.2%. Now, why this data is so skewed is because it takes large areas into account. An example of this would be capital cities going up by 0.3%, but what you'll see is Sydney's up by 0.3, Melbourne's down by 0.2, Brisbane's up by 0.4, Adelaide's up by 0.5, and then Perth is up by 0.8. So you can see it's just an average of these things, and that's why you need to take this with a grain of salt. You need to go deeper into the data, otherwise you won't get an idea. This gives you a very high level of what's happening around the grounds. When you start looking at annual numbers, you can see some outliers here. When you look at Brisbane up 14%, you're looking at Adelaide at 15%, Perth at 23%. It's absolutely wild, especially when you compare that to Melbourne, which is going the other way. Now, there's a lot of calls out there to say, well, we should counter trade this. Let's go to Melbourne because everyone's looking elsewhere. And that's probably the wrong way you counter trade. It's often referred to a falling knife or catching a falling knife. If you think about it, a falling knife is dropping and you're thinking, I'm so smart, I'm going to get into this market earlier than anyone else. And as you try and catch the falling knife, it slices you open. Now, I don't condone any sort of violence, especially here on the channel, but the reality is people are going to get wrecked by trying to pick bottoms. Because if you pick bottoms, you get smelly fingers. Boy, I'm on fire today. Now, this is a cool little graph here. We've got annual growth rates and we're here at 6.2%. Now, there is speculation that, okay, well, we've peaked in terms of the rate of growth. We should start seeing this go down. Again, this is an average. So if we're going to see larger markets like Sydney and Melbourne slow down even further, then yes, we will see these numbers drop off. What I've been covering off for the better part of 4 years is this graph here. And in the red, we've got capital cities. In the blue teal color, we've got regional areas. And what I said on this channel 4 years ago, I said, look, what you need to do is you need to protect your downside. And this is where you need to position yourself for whatever crash or correction comes next. But you also want to be in the right areas to give you the maximum amount of growth. And to me, if I looked at this objectively, I would say the blue color is the one I want to be in. Because when I see the dips, they're so much larger in the red color, which is the capital cities, and I compare that to the regionals and they hardly dropped. When I look at the increase, I see in 2021, we saw growth of 23% for capital cities, but it was closer to 30% for regional areas. And then when we saw interest rates go up, we again saw the dip in capital cities by 3%, but we saw a dip in the regional areas by just over 1%. So to me, what I want to do is I want to be getting into areas that have less volatility. So when I look at my downside, even if the market moves sideways or slightly dips by a couple of percentage points, that's the market I want to be in. Because when times are good, these markets often take off. And when you're looking at long-term growth, you've got to have that long-term perspective. Even if you look at a graph like this, even if you were to pick the worst time to purchase property and you saw a decline of 7%, you would actually be at all-time highs only a couple of years later. And that is why it is so important you get the right strategy and plan, not just go out there and fluke it, and definitely don't go out there taking the risk of house and land packages and off the plan units, because that will be a shortcut to you failing pretty badly. Now, what we also saw was the housing approval numbers come out. And this is where it starts getting very interesting. Now, apartments boost housing approvals, but not enough. A 34% leap in apartments, townhouses, and semi-detached homes pushed new housing approvals to their highest monthly total in a year and a half in July, the first month of National Cabinet's 5-year target of building 1.2 million new homes. But even as the volatile monthly figures, which can vary from month to month based on the timing of individual project approvals, lifted the July total to 14,797. The national run rate of new housing approvals, a leading indicator of activity, fell below the needed target. When I talk about whether you should purchase houses or you should purchase units, if you want a detailed breakdown of exactly that, let me know in the comments down below, units versus houses, and we'll do a deep dive analysis of why one may grow more than the other and how it differs in different areas. But one of the key things that I've mentioned on this channel before is supply. You can't just say, oh, this is a really popular area, everyone's gonna wanna buy there. Yeah, that's great. But if it's really popular and there's available land or there's zoning allowing for multiple stories of units to go up, that means there's going to be a hell of a lot of supply coming out too. So the supply is going to still outweigh the demand. If you think about it, we go out there and we say there's 10 people that want to buy a house in this area and there are 12 properties available. That means the buyers have a choice because they can say, well, if I don't want to buy this property, I can buy this property. There's less of us, more of the properties. Now, if the opposite occurs where you say, okay, there's 100 people in this area and you say, well, that's 10x the popularity, that must mean it's good. Well, what happens if I said to you that supply is looking at 500? Then you would say, well, that means prices should go down a lot because there's so many houses still going to be available even after the 100 people go and buy the 100 they want. That's why you need to understand both sides of it, not just look at, oh, well, everyone wants to move to Melbourne. Fantastic. But there's a hell of a lot of supply out there, and that's why I wouldn't be touching that market. Approvals of detached houses, which accounts for the bulk of new housing creation, ticked up 0.3% to a seasonally adjusted 9,354 in July, lifting the yearly total of 107,214, up 1.5% from its level a year earlier. Oxford Economics Australia senior economist Mary Kilroy said, improvement from a year ago in development inquiries, land sales and construction finance leads suggested that the worst for new home approvals had passed. We forecast that the new house construction will lift 6% year on year nationally in FY 2025, Ms. Kilroy said. But a sustained boost in apartments and other attached homes was crucial to an overall lift to get to that target, JP Morgan economist Jack Stenson said. What we can see here is in the dark blue, detached homes, and in the light blue, we've got the attached homes. And although we can start seeing a little tapering off and starting to potentially see an increase here, it's still significantly lower than whatever the averages were over the last 5 years. And that is why there is a concern, because there is no way we're going to have enough supply come onto the market, especially if interest rates don't start dropping. Because you got to think about it. You got to get the approval. So the government's got to play their hand in giving you faster approvals. And we know no one's fast these days. Then you've got the whole other battle, which is a bank wanting to lend for construction loans. Once they do that and you have the ability to borrow, then you can go and build. Now that's still going to take you between 12 and 18 months, depending on what you buy and what you build. It looks like a month into a federal government push to build 240,000 new Aussie homes a year, the nation is already 74,000 homes behind. The figures suggest a $3 billion federal fund announced to reward states and territories for adding 1.2 million residences to the national housing supply by 2029 will go unused, with industry forecasts suggesting the nation will miss its goal by about 200,000 homes. It's pretty sad to see that we're in an environment where we can't build enough homes. Now, I know people will probably flash into the comments and say, well, it's pretty easy, you just stop the immigration taps. But we've already discussed why that's not looking likely as an option, because we have the economy just holding on. Now, we've started seeing banks come out and start slashing their home loan rates as well as their term deposit rates. Now, once the term deposit rates start cutting and you realize maybe the money here isn't being useful, that's when some people will start using that money to either invest into assets or start using the money to then start reigniting the economy. That is why the interest rates get cut, because it means that the economy is slowing down. We need more money to go in and start transacting. So you can either do that with buying assets because there's taxes and things like that involved, or you can go out there to more cafes and restaurants and splurge. A lot of people suggest that maybe we're so far away from interest rate cuts, inflation's really high, but I want to know your thoughts. Do you think we're going to cut interest rates in the next 6 months? If you do, put down in the comments down below the month and the year as to when you think it's going to happen. I hope you guys have enjoyed this video. If you have, smash that subscribe button, share it with someone that needs to hear this sort of stuff. And if you're wanting to make some moves and move at speed, then definitely contact our team. I'll leave a link in the description below so you can book a free call with us. I hope you guys have enjoyed this one. I'll catch you guys on the next one. Thanks, guys.